Hey everyone, this is the YouTube Live for today, Friday, February the 9th, I believe it is today. Well, yesterday I had lunch with a client of mine who had a couple of bad trades that he did outside of my mentoring or my coaching. And then I had a few people ask me what the stop loss strategy is that I adhere basically to. Now, I did a recent video, and you can go check on my YouTube channel on my stop loss strategy, but I thought this would be a good time today to quickly review the ideology of stopping yourself out from a near-term perspective. You know, long-term trades, you have to give a lot more breathing room. When we're talking about the near-term gyrations in the markets, it is really important to be able to stick to some sort of stop loss strategy. Now, the basics of this is all about the fact that you can always get back in. And I believe it was actually Paul Tudor Jones who said that. He's a famous hedge fund manager. And I don't know if he's the first one who said that, but I know this is a really good principle to live by. But the idea that you can always get back in, okay? And I gotta tell you, I really had a big aha moment when I started first really embracing this basic but really, really important idea of risk management about 12 years ago, that you can always get back in. So let's do a real quick real-time analysis on the S&P 500 and how you could have used this analogy in just the past few days. So let me quickly reverse the camera and have a look at the S&P 500. So the very basic rule for me is to get out of near-term trades. I'm not talking about long-term positions, but near-term trades upon basically the first sign of fire, right? So right when I start to smell fire, that's usually a good spot to start exiting. What is that? What does that look like? It's usually the first real reversal that I want to look for, and it's usually is marked by either a big exhaustion day where the market attempted to rally and then failed to continue, or it's just a real big down day where the market opened and then just kept falling all the way. So in the case of the S&P 500, what one could have done is exit here, right? That's your first real exit day. And if you would have done that, I'm just to give you a quick idea, because you never know, the market could have bounced back the next day. But in this case, it didn't. And so far, it has now from peak to trough fallen about 6.5%. Right? You can do the same analogy on maybe a stock like, I don't know, let's take UPS, for example. Okay, so here's a stock that if you would have gotten out at the first sign of fire, which probably would have been, the first meaningful down day that started, in this case, also breaking below a range, probably would have been this day here, right? And look what happened after that, right? You can see that the stock since then has dropped about 15-16% more. So the idea is you can always get back in. And again, please give us a thumbs up, like, or leave us a comment if that makes sense. But this is a real basic and really super important risk management strategy. So again, quickly going back to the S&P 500, you could see how that could have saved you a lot of money. Now, the thing is, you can always get back in, right? And that's the most difficult thing for a lot of people to do. A lot of people are not willing to stop themselves out, but you can always get back in. So, for example, just a few days ago here, on this day, you can see that green candle. Let me make this a little bit larger. You can see that we had an attempted bounce, and that would have, for me, that was not yet the time to get back in. I needed to see confirmation. So just like when you stop yourself out upon the first sign of fire, you don't, to get back in, you actually need confirmation. So you can get out of the first sign of fire, but for getting back in, you do need confirmation, right? So it was only a one-day bounce, and that was it. But I'd like to usually see at least a multi-day bounce to get back in. So that's a real basic risk management strategy, but one that has over the years really served me well. So particularly now as markets are getting more volatile, the key here is to get out of the first sign of fire and then only get back in once you have confirmation for trade.